So let's start talking about what's going on with the economy, because of course, what happens to the economy has a profound impact on real estate. What happens on real estate has a profound impact on the economy. So back in April, three financial firms were talking about a V recovery: Goldman Sachs, JP Morgan and Morgan Stanley. And what actually happened is we have a V-shaped recovery in spades. We're going to see that in this next slide. As you can see, we're plotting along here, going back to 2012, in positive growth rates, 3% or less. I mean, 3% was the highest we achieved. And then all of a sudden, coronavirus came along and we fell off like a rock. And then third quarter, we came roaring back. Now, we're not quite sure what's going to happen in the fourth quarter. It could be negative because of the recent spike in coronavirus cases. And we'll have to, and that remains to be seen how that's going to look. But I looked at the Wall Street Journal survey of economists. They survey, I think it's 600 economists, and consolidate those projections. And this is annual. So 2019, the actual is 2.2% growth. We're projecting a negative 2.7 growth for 2020. And then 21 and 22, they're projecting around 3% or better. So the economists are looking at the economy rather bullishly at this juncture. Obviously, the coronavirus may have more of an impact than it has, and that remains to be seen. It's a bit out of our level of expertise to talk about that. The next trend, so we're going to slide into unemployment because unemployment has a profound impact on the economy as well as housing, of course. And you can see where the unemployment spiked up in the second quarter, up to 15%. This is the gray bar is the nominal rate the rate that's normally published in the papers. And it came down to less than 7% in October. The red line is what is commonly referred to as total unemployment, which includes people who are just can't find a job or not looking, or they're underemployed. And you can see that rate is much higher. But the takeaway on this is that unemployment has come back, has fallen down considerably, and we can actually look at unemployment insurance claims. Unemployment insurance claims spiked at 25 million. These aren't claims, these are people receiving unemployment insurance. So you get first-time claims is one metric. This metric we're looking at is people actually collecting unemployment. So that metric has fallen from 24.9 million back in May all the way down to 7.3 million. Still too many people, of course. We had a reduction of first-time claims last week of 538,000. So unemployment, the economy had been picking up steam. And of course, as we said earlier, there may be kind of a fall off now because of the spike and most recent shutdowns. Here's a conclusion reached by Jed Kolko, who is the chief economist of Indeed. Indeed is a job hunting portal that many of you may have heard about. He produced a state of the labor market, and his conclusion was that in May, after payrolls plunged and unemployment spiked, the Wall Street Journal panel of economic forecasters projected unemployment would not fall below 7% until the first half of 2022. That's 18 months from now. The we've already passed that milestone in October. We're at 6.9%. So the economy has fared much better than people projected. Of course, the Fed has had a lot to do with that by pumping in liquidity into the money markets. And then the federal government has also had their stimulus packages as well. And back up, one more comment on that. With all this money flowing into the economy, at some point we may have too much money chasing too few goods, which is which always gives rise to inflation. The expectations are that won't happen in the near future, but it's something to watch out for in the intermediate future. Something that we don't hear a lot about is business applications. You can see how they spiked in the last half of this year. People unemployed, they're going to look for another way to make a living. They get innovative, they get creative, and new businesses can be a strong engine of economic growth. And so we're just going to see how that impacts the economy going forward. Some people are worrying about a mortgage meltdown, similar to what we had in 2007. So we don't see that, and the experts we follow don't see that. First of all, we started at about 4.76 million forbearances in May 29th. That number has dwindled down to 3.01 million forbearances current mortgages that are in a forbearance arrangement. Of all the forbearances that have been started, 40% have come out of forbearance on a performing basis. In other words, the borrowers were able to maintain their payments. About 9% of these folks actually paid off the loan. Now, maybe they sold the house, but so about half have come out without too much economic damage to themselves or to the lenders. So that's one thing that's happened. We note there's a big difference between the current year, the current environment, and the mortgage crisis, the recession in 2008, because we don't have, homeowners typically have equity in their house. We have stringent underwriting requirements on the loan side. Builders were overbuilding, and we're going to see that in a minute. We're overbuilding and just throwing inventory out there for people to buy. People were buying homes without really being qualified to buy them. We do not have enough homes coming up, or barely have enough homes coming up now on a national basis. And the lenders are very stringent on the underwriting standards. And we've got people do have equity. Typically, people get in their home, they stay there a while, and they're building up equity, so they have options if they do get into financial trouble. And we have a record low inventory of homes also. So if you do need to sell, it's fairly easy to sell.
The next arrow.
The likelihood of us having, So Ivy Zellman is the founder of Zellman & Associates. This is arguably the premier consulting and data company in the real estate industry. And she's very highly regarded. And she's saying the likelihood of us having a foreclosure crisis is about 0%. There's also a question about whether we have too much personal debt. And personal debt has indeed grown to a fairly high level. We're at about $14 trillion. In 2008, we were at $8 trillion. This is household debt. So there are some alarm bells going off in that regard. But when you look at a metric, it's always a good idea to compare that metric to something else. And so what they do is they look at how much does it cost per month to service that debt and what is the household disposable income. And you compare that ratio, and that ratio today is at 3.72%, which is lower than we were in 1980. We were at 4.38%. So even though household debt is higher in absolute terms, it's also lower in relative terms than it has been historically. Outlook for interest rates in the economy is near zero interest through 2023. And that is Jerome Powell himself, who is the chair of the Federal Reserve. So the Federal Reserve is committed to keeping the liquidity in the economy. And so there are no headwinds in sight that we could see that might give rise to recession in the near future. So let's shift gears to what's going on with nationwide housing trends. Lawrence Yun is the chief economist with the National Association of Realtors. And he has reported, and we just heard this yesterday, third and fourth quarter home sales are going to be 20% higher in 2019. Home sales are 3 to 5% higher on an annual basis. So if you take the 12 months, they're going to be 3 to 5% higher. Home prices are overall for the country are going to be 7 to 9% higher than 2019. Low inventory is a big constraint to even further gains in home sales. So you could see when we talk about low inventory, you could see where we are. We're in a hyper seller's market, and everybody who knows anybody who's sold property recently knows that they're typically selling really quickly for over asking. That's a very typical scenario. A seller's market is anything less than 5 months. They say 6 months on this chart here. And a buyer's market is when you get into a listing inventory over 7 months. Of course, the month's inventory is what this chart is measuring. And that's a metric that's derived by dividing the number of active listings for a period of time divided by the number of sales. And that gives you an inventory, a monthly inventory level. So right now we're at very low levels of inventory. We also have to take into consideration new housing. Housing has come back. You can see back in 2006 how much housing we were building, well over 2 million a year. And then it fell off with the Great Recession. It started coming back. It dipped down with the coronavirus, and then it came back up. We're at about 1.5 million houses now, new homes now per year, which is about where we need to be, but we need to be there for quite a while. So in the meantime, we're facing a housing shortage. If you compare inventory and home prices, you could see low inventory. It's economics 101, folks. Low inventory should cause, or scarcity should cause, an increase in prices. That's just a general economic principle. And you can see this in action on this chart, where home prices have gone up nationwide to well over 300,000. These are median prices. And the supply of inventory is down at historical levels. If you want to compare sales and listings, and this is kind of an anomaly, sales are up on existing homes 10.5%, new homes 43%, listings on existing homes are down 39% and 33% for new homes. And the reason this is happening is because whatever goes on the market sells really quickly. There's some concern about whether price increases are getting ahead of ourselves. And certainly since 2008, prices have increased on average 3.8%, since 2012, 6.1%. If you overlay that 3.8% since 2000 and compare that with where we are, which is the green line, you could see that we've been tracking pretty close to 3.8%, except for very recently when we spiked above it. But as we said before, the market conditions are totally different than they were back here in 2006, 2007, 2005, because we're not building too many homes and they're not giving away your loans. You have to be credit worthy to get a loan. I think this will probably come down a little bit as new homes, more inventory comes on the market. That will probably mitigate a bit, but we'll have to wait and see. So this is a trend line of the 2020 mortgage rates. We've had 13 rate reductions this year at one historic low after another. Last week, we're at 2.72%. That's the Freddie Mac 30-year fixed rate. And Fred is going to give us some more insight on that momentarily. But the impact of low rates has a very beneficial impact, of course, on affordability. Affordability is how much can you afford to pay every month. So if you look at this graph tracks housing affordability nationwide from 1990 to today. The higher the level, the more affordable the home is. And you could see here where we're at very high affordability levels since 2016, and we're still at a very high affordability level despite the high prices, only because the interest rates are so low. Affordability here was kind of off the chart because we were in a recession and we were in a deep seller's market at that time. Okay, so let's shift gears to people on the move. Work from home is a catchword you're going to hear a lot about. Upwork is, if you're not familiar with them, that is a company that pairs up, that provides gig workers with a place to post their services and their credentials, and then companies can post jobs that they need done. Like if you need a one-off graphics design job done, you could post it on the Upwork platform, and then all the people who are graphic designers could bid on that job. So
like a higher end Fiverr.
It's like a higher end
Fiverr, right?
Fiverr. So, so they did a study on the impact of work from home, and they found that 14 to 23 million Americans are planning to move as a result of being able to work from home. And that has profound impacts on housing, by the way, of course. 3 to 4 times the normal near-term annual migration rates. 20.6% of people are moving because they can work from home. If they're in a major city and if they're in the suburbs of a major city, that number drops to 12.2%. So we're seeing a tendency to remove from more dense urban populations to less dense urban populations because people they can get out of the city, they can go to a bigger home with more space around them, because as long as they got a broadband connection, they can work. Between 14 and 23 million people plan to relocate because they can work from home. As we said, 20.6% are currently based in a major city. And we're going to see what the impact on rents is on this in a second. And 55% of those people are going to move 2 hours away from their current location. A large demographic tailwind has arrived as well. Those are millennials. They're reaching the first-time home buyer age, which is right about here. And here's the largest millennial cohort. So they're just about 6 years away from being first-time home buyers. And that is going to have a profound impact on housing. And we're going to see here that of these millennials, 52% of young adults resided with one or both parents, which is up 47% in February, up from 47% last February. So people have had to go back to their parents for whatever reason. Either they lost their job or they were living in cramped quarters and they wanted more room. Technology plays a big part in their house hunting. Of course, they use mobile devices to search. I think we all do at this point. And communicate with their real estate agents. Millennials are forgoing, but here's what's interesting. Millennials are foregoing their starter homes in favor of larger or more upscale properties. So people who are going to move up 3 or 4 years from now from a starter home to a move-up property, which is the typical trend, they're going to be competing for that same home with millennials who are going to skip that stage of the housing cycle. People are also migrating for other reasons. They're migrating interstate because they want lower taxes and less regulation, and they want to go from a cold to a warm climate. Maybe there's commonality of values and ideals. So here's what's happened. Here's the impact on rents from all these demographic changes we're seeing with people moving because of work from home or they just want to be in a different area. Rents have actually fallen this year in New York City, San Francisco, and San Jose as people moved out. Rents increased in Memphis, Phoenix, and Riverside, California, because that's where people wanted to go. So they put upward pressure on housing. Okay, am I sharing?
Yep.
Okay. So we're going to go into 2021 predictions here. Fred Arnold, you're on deck. We'll get to you in a second. Got back to Lawrence Yun. He's saying it's going to be one of the best winter sales years ever. He's projecting that home sales are going to rise 5 to 10%. Jobs will continue to recover. Record low interest rates will continue. And work from home is going to be an impact. He's projecting prices going to rise nationwide 3 to 5%, which is down from where they're projecting for this year. I'm going to just show recent spread of mortgage rate projections, and then we're going to invite Fred Arnold to chime in. So these are various agencies, government-sponsored entities, mortgage bankers, National Association of Realtors. They're all projecting 3% interest rates basically for the next year. And that may go on into the year after even. So anyway, Fred, can you unmute yourself and give us your take on all this?
Yeah, thank you, Phil. Give me a thumbs up if you can hear me okay.
We can hear you.
Perfect. Well, thank you. Let's talk about interest rates just real briefly, Phil. Thank you for having me on. And I made a few notes here that I do want to comment on. One is I think rates are going to stay low in the long term. And the reason why is I'm going to have a little bit different take. I talk to probably 2 or 3 new customers per day. So I get a good idea of where everybody's at. Number one, there's about 10 to 15% of the market that don't have jobs. Enough about this. If we would have said a year ago that 10 to 15% of people will not have a job, oh my God, the economy would crash, right? Well, it kind of has, but it's been kept up artificially by the Federal Reserve in monetary policy, along with us spending like drunken sailors in this country. The reason why I say that is long-term, we're going to pay a price for that. And that's going to be a little bit of a challenge. So number one, those jobs aren't going to come back probably till 2023, 24, because we have to retrain 10 to 50% of the market or wait until their jobs in hospitality or restaurants will come back quicker, but hospitality and travel, number one. Number two, choice in leadership. We have a new president coming on board. Like him, hate him, whatever, doesn't matter. The truth is he's going to regulate more like when he was vice president with the Obama administration, and he's going to put some constraints on the economy. through regulation. So that's one thing that Trump did was maybe a good thing nobody talked about was a decrease in regulation. He's going to cause more regulation by who he chooses for his cabinet picks or the head of, the different departments he can pick. So we're going to see that, and it's going to cause the economy to stay slower. It's just a philosophical choice he's going to have. COVID's going to continue for a while. It's not like we're going to magic pill, and there's going to be residual effects, partially because of social media and because of the media. The media, they only, sell eyeballs on newspapers and on TV when it's hysteria. And so you're going to have some individuals in society that aren't going to come back and maybe go spend money at the supermarket, spend money at the mall, and spend money at different places, keeping the economy slow, therefore keeping interest rates low. And last but not least, you're going to have a Federal Reserve chairman who's going to continue as he was appointed, and he's going to stay on for. But even more important is Janet Yellen is going to be the new Treasury Secretary. She was very accommodating when it came to fiscal policy with the last administration, the Obama administration, and she's going to do the same thing with this administration. She normally a tiger doesn't lose his stripes, whether you like it or not. She's very accommodating to fiscal policy, and so you're going to see these things happen. Also, we're very shy about increasing interest rates and slowing economic monetary policy, and we proved it back in the last 5-6 years. We've been slow to raise interest rates, and we've been slow to withdraw the stimulus that's out there. And I think we're going to be the same thing with this administration. So we're going to see rates low, which is good for the consumer. It's good for you if you're borrowing money. If you're looking for yields on your bonds, it's not good for you. So it just depends on where you're at. It's going to be good for the real estate market, which is going to be good for you if you own a home or you own an apartment complex or something like that. So that's a little bit about interest rates. I want to talk about the unemployment. I want to add more color to what Phil said on unemployment, Phil. And that is unemployment's gone down because benefits have run out. When you don't have benefits, you no longer are on unemployment. So if you're no longer on unemployment, you stop searching for a job. There's also called pandemic unemployment, and that is relatively high. We don't report that. The government seems to always hide reporting the truth as far as I'm concerned, because unemployment, you're unemployed if you're no longer getting benefits, and stop looking for a job because you can't find one. I have a significant other who she's in hospitality. She stopped looking for a job and she can't find one, and she's no longer getting unemployment benefits. So we're going to see that. So we're going to see a big unemployment number drop simply because people are no longer going to qualify for unemployment, for example, in the state of California. I want to talk about the forbearance situation. We're going to continue to see that improve. And the reason why it's improving is because a lot of people took forbearance and they kept making their payment, or they want to refinance, so they got to catch up. And so as soon as they get a job, they're going to go ahead and catch up for 3 months and be able to refinance. So we're going to see that happening and that forbearance number coming down. Right now, 1 in 500 homes is in foreclosure, and that's it. And in most cases, there's enough equity for them to get out and sell it. Also, if we see a foreclosure crisis of any kind, banks are going to be very aggressive to do short pays or allow that, because their losses will be minimal relative to the 2008, 2009, 2010, because values are still high. Let's talk about affordability real quick, Phil. And that is, the media is saying, oh my God, affordability is terrible. And Phil showed you a picture of where it's not too bad. The reasons why it's not too bad is rates went from 4.25 to 2.75. And in fact, as long as they've been tracking interest rates, Fannie Mae and Freddie Mac, this is the lowest they've ever been. So what that does for you is, yeah, your payment might be higher because you borrow more money. But last year, 25% of your payment went to principal. Now your payment might have gone up by 15%, but 40 to 45% of your payment goes to principal. And that helps affordability tremendously. So you're able to knock out your principal a lot faster. In addition, The median price of a home has gone up 14% according to some media outlets. So, oh my God, things are going up and are so expensive. Well, that's not the truth. When you think about median prices, Phil, it's half the prices sell, half the homes sell above this price and half sell below it. Well, there's just more expensive homes being sold now. It's not like every home's gone up by that much. If you really want to know the truth, call Phil, and Phil will tell you in that specific neighborhood where it's going up. Typically 5 to 7%, but not the 14%. It's just more homes. The more number of homes are selling at a higher price, number one. Number two, builders are building homes at 2,400 square feet and bigger, 18 to 24, because they can't make any profit on smaller homes because the land is too expensive, the legal's too expensive, the labor, and the lumber. And because you have those 4 L's so expensive, they can't afford to build homes that are less expensive, therefore causing the median price to go up. I want to talk about maybe one last thing, Phil, and then I'll field any questions you have when it comes to interest rates. The self-employed borrower. Many of your clients you refer to me, Phil, are self-employed and or retired. And how do you qualify when you don't have any income like you did before? Well, first of all, let's talk about self-employed. Nowadays, if your credit's really good, you have good reserves, and you're putting good money down, they only require 1 year tax return. So if you're self-employed right now, and before you file your 2020 tax return, see me and I'll tell you how to best position yourself. So this year you can claim a little more income so you can qualify because you've been writing everything off. In addition, depreciation is your friend. If you can depreciate anything, we add it back into your income. So just a couple of tips on self-employed borrowers to make sure that you plan ahead of time, especially if you'd written some of your debts off. We're not using COVID against your self-employed and had a drop in income as long as you can prove your income's gone up or you cut your expenses so your profit's still the same. So we look at that too, Phil. And last but not least, let's talk about the retired borrower. This is really important. I mean, you go to someone online, they don't know what they're doing. And I share that because I have self-employed borrowers that call me all the time and say, well, I went there and they said, I don't have an income because I'm retired. I got Social Security. I get a small pension of about $1,200 a month. So I make about $4,000 a month and I want to buy a house. And I want a loan of, let's say, a couple $100,000. Well, the truth is, if you have a 401k, and let's say you have, and this is really important if you're retired or thinking about retired, let's say you saved $400,000 in your 401k, pretty good amount, and you're 59 and a half or older, and you can draw from it without having a penalty. As long as you have 36 months of that money in that account, you can take a draw. The draw only has to last until you close escrow. You can cancel it after that, and that becomes your new income. So let's just do an example. Let's say it's you need to draw $3,000 a month to qualify. Well, 3,000 times 36 months is just over $100,000. You have $200,000 in your account, you qualify with $3,000 a month in additional income, because we just want to make sure you have 36 months of that draw. And again, when you close escrow, you can decide to close it. You don't have to keep or not close it. Stop taking that draw. You don't have to take it just because that's what you use to qualify. So, Phil, I touched upon interest rates that are going to stay low. I touched upon unemployment. It's higher than you think because people are no longer filing for unemployment. So that's going to keep interest rates low for some time. We talked about forbearance. It's not as bad as people think because a lot of people called about it. So they were put on forbearance but never missed a payment. We talked about self-employed borrowers. There are some solutions. And affordability. Now, 40 to 45% of your payment is going to go to pay down principal. And that's why we're seeing a lot of millennials. My kid just, is looking in the Thousand Oaks area, and it's a good example of why people are buying. So, Phil, I'll turn it back over to you. Just some thoughts and on what's happening in the mortgage area.
So, Fred, I thank you very much for your insight as usual. You know so much about this business. It's really a pleasure to have you as a guest at these conferences we have. I do have a question. If someone were to take a loan now, a 30-year loan for 3%, will they be able to brag about that 5 years from now?
Oh, well, yes, but rates aren't going to 7%. And the reason why is if they go too high, we're going to plunge into either a depression or we'll plunge into another recession because we have so much debt, that we just can't sustain it unless we have huge economic growth. And so, yes, you're going to look like a genius. Rates will level off between 4.5% and 5.5% and be normal there. And then they'll come back down maybe as soon as we hit another recession, let's say another 4, 5, 6 years from now when we have these normal. Yes, but absolutely. If you go long 30-year fixed, take that money and invest the difference of your savings into the broad market, diversify yourself because it's going to be a great interest. I'm celebrating my 30th year next month, Phil, in the business. I wish it was my 30th year in life, but in business. And Phil, rates were 10.5%. And I was, always hearing from my parents on where they were 18, 19%. And I'm like, yeah. Well, geez, I tell my kids 10.5 and they go, yeah. I don't want to pay more than 3.1. Yeah. And it's quite remarkable, but yes, get a 30-year fix because here's what's going to happen. And all of you guys are savvy. A lot of you I see here I've spoken to, they're all savvy borrowers. If you have an entry-level home, buy the next one up and rent your house out because rents are going to continue to go up. But your payment is fixed except for taxes. They can go up a little bit each year because of Proposition 13. Your insurance will go up a little bit too because it costs a little more. But other than that, you're fixing in, but you can raise rents. And let me just tell you right now, they're not making more land in California. The labor is not getting less expensive because of our choices and because we just don't have enough people you want to solve the immigration problem, immigrate people here that want to build homes and then you'll solve the problem. Really, you'll have a lot of hardworking people and you'll get a lot more labor, but we just don't have that. Yeah. The legal side of it's so expensive, like we talked about, and the lumber's expensive.
Yeah. Okay. Thank you so much, Fred. We're gonna kind of move on a little bit, but if you could stick around, because we're gonna open it up for questions. I have gotten a couple questions in the chat, which we'll address when we're all done. So if you all have any questions at all, we don't have much longer to go on this. So we'll start addressing your questions and we'll do the drawing at the very end. So I'm gonna go back to sharing the screen.
Just click share. That one.
Here?
Nope, that one.
Okay, back to screen sharing and next slide. For next year, we're projecting home price appreciations. There's a wide array of projections for national home price increases, median prices. It depends on the agency or the company that's doing it. Zillow is high at 7. Zelman, who we mentioned earlier, is at 5.9. CoreLogic is at 0.2, basically a break even next year. We've noticed recently that CoreLogic tends to be much more subdued in terms of their projections on home price appreciation, and nobody seems to know why they're so much lower than all the others. But we'll just have to see how it plans out. But right now they're looking at 4.7% for next year as National Association of Realtors. And that's kind of in the middle of the pack. We're going to skip through these next several slides. Okay, now we're going to go to Santa Clarita. Some of this we've talked about before. This first slide is escalating rents, and as a renter, or anybody knows a renter, every dime they put out in rent is lost forever, as opposed to buying where some portion of that goes to your equity and you get to keep the appreciation on the property. So this is all lost money except to the landlords. We have some new residential construction, about 36,000 units coming in to the Santa Clarita Valley. They're in planning or under construction. And this is a breakdown. This is back from March. These 7,200 units are under construction. Another 4,500 units were approved. and 24,000 units are on the drawing boards. Most of those is in the 5 Point Valencia project, which is in unincorporated Santa Clarita Valley on the I-5 and the 126. Here's a list of the actual developments. And if you have an interest in these, I can talk to you more in detail about them. On hold is on hold. They're on pause, under construction, environmental impact review, planning commission review, and so forth. But just to give you an idea of the number of different developments in process on the pure residential side, and the number of units. That's in the city. And then you add in the unincorporated areas of Santa Clarita Valley, and you get a bunch more developments under development. There's even a couple that are not on here. Williams Homes is building some high-end homes. Here it is. In Castaic is 497, but I just saw another one that's planning to develop over there as well. Some of the units, residential units that are coming in, are actually in mixed use development. So there's commercial and residential in one development. And of course, the big daddy of them all is the Valencia project, 21,242 homes and 11,500,000 square feet. So you could see historically how many units we've been building in the Santa Clarita Valley. You have to add these two together. Last year was about 1,624. And then this slide gives you a projection of what it's going to look like through 2025. So by 2025, we'll have about 2,600 units built. These are actually units permitted. Putting that into context with the number of homes we're actually selling on existing homes, we'll probably close around 3,500 homes in the Santa Clarita Valley this year. So this is going to make up a huge additional influx of inventory. One other thing I want to mention about the Santa Clarita Valley is we have a tremendous amount of industrial space coming on board, about 13 million square feet on the drawing boards or under construction. And Amazon has actually taken 2 of those projects, has leased 2 of those industrial complexes. One is in the Needham Ranch in Newhall, and the other is in the Commerce Center in Castaic. So we are on the radar for big companies to move into this community. And it's almost every month the Economic Development Corporation is publishing another company that's relocating their headquarters or a big division out here. So it isn't just about building new houses. We're also building industrial and commercial buildings to go along with it. And the city's goal is to produce a lot of jobs along with the houses, so people don't have to commute. So we're going to go into this series of charts. So what we do every month actually is we track, this is 3 months worth of data year over year. So we track a number of metrics that are important to us, and we split it out between attached properties and detached properties. So attached properties are typically a condominium, a detached property is typically a single family residence. And you could see, and this is November's data, the number of active listings over the same period for 2019 was down 29%. 2019 was down 26% from the prior year. So this is detached, attached, and this is everything together. So you can see the active listings has dropped. It's following the same pattern as the national data. Pending sales have increased. So the number of listings are down, the pending sales are up. Number of sales are up, which you'll see in a minute. So how did that happen? And I'll explain it. You can see the pending sales are up 26%, which is higher than the prior year. and the prior year was higher than the preceding year. Closed sales are up 41% over the same period for the prior year. Median sales price is up 11%, 10.6% for these last 3 months, ending November 30th. If you own a single family or detached single family residence, that number is 12.3% versus 4.3% for the prior year. So prices have gone up much higher in the Santa Clarita Valley than they have on a nationwide basis. So here's why this is happening, is because November median days on market has dropped from 22 days to 6 days. That's how long does it take for a property to go under contract from the time it hits the MLS as an active listing. And we all know, have anecdotes. In fact, one of our guests, I'll read his comment in a minute, had I think it's an uncle in Palm Desert. Well, I'll read it, but he sold his house in 1 day, over asking. And we're seeing this a lot. Anecdotally, we see it all the time. And the month's inventory. Remember, we talked about month's inventory earlier in the discussion, has dropped by 36%. The houses just aren't staying on the market. This chart, I like this chart because this is not 3 months, this is 1 month. This chart shows you what's happened to sales prices since 2008. So we are now, for detached homes, we are now at just under $700,000. In March 2006, we hit the record, the preceding record of $634,000. So we've already beaten the preceding record. These are historic high numbers, folks. And we expect to see those numbers go up even higher. Next year, we think there's probably going to be more inventory on the market as people possibly stop hunkering down from the coronavirus. So if they stop hunkering down because of the coronavirus and want to move because of work from home considerations, there might be more listings on the market. So I don't think these high rate of price increases are going to be able to be sustained. However, I do think that we will have higher prices next year. And with that, I'd like to turn it over to Perry Jones to give us his insight into the market from the title insurance company perspective.
So I can't see everybody right now, but I'd ask you to raise your hands. So I want to see who my crowd is here, and I recognize a few of you, including Hugo, that's smiling. So again, how many of you are currently own a house and you're an investor, maybe have a rental house also? Okay. How many of you are looking to possibly buy another house, or you want to buy your first house? Okay, I see one. All right, so let's talk about what's going on. We've all lived this, and it's an amazing thing to see because it doesn't happen that often, but we've been lucky enough to witness this kind of trend twice. So how many of you remember when COVID started, there was a run on the markets for toilet paper, for paper towels, for hand sanitizer, and nobody could find any anywhere. Well, then there was a run on RVs, trailers, anything to get the hell out and go somewhere. And these things are short-term vehicles that maybe last 3 to 5 years, and people are paying $130,000 for one. Okay, they just want it. And the interest rates are not that low on those, by the way. And now we're seeing the same thing going into the housing market, because everyone now says, I don't want that little $3,000 a month apartment on the beach. I want a house. I want a house somewhere. I want a place where I can hunker down and hang out and just enjoy life a little bit and have some room. So housing prices, good news is, are going to go up. And Yoon's never always the best. The guy from CAR or NAR, I don't love him. He's not that great an economist, but I believe that he said 4%. I think we're going to see 5 to 6% price increases on housing in Southern California. And Fred, I said last year that I thought interest rates would drop. And I got some maybe. Well, I think they're going to be at 2.5% every day of the week and maybe 2.25%. And for those of you that care, you can go and look at what a 10-year bond in Greece is right now. The yield is 0.61%. The 10-year bond in the United States of America, which is not a Greece, is 0.9% or thereabouts, 8 something. So would you, as an investor, say, I want to have my money sitting in Greece bonds that may default or US bonds that will never default? I'll send my money to the US because I'm looking for a return on my investment. Everybody I've ever talked to here in the last year says, we're looking for a place to get a return because you can't get a return in the bank with your cash. It sits there and it earns you 0.01% or whatever you may work out. So they're looking for places to go. And one of the places is real estate. And so people are saying, well, rents are going up. They may not go up that much more, but I know what I've got. I've got an asset. I can sell it. I can live in it. I can rent it. So the money's gone into that. And I can think it'll continue. And there is a shortage like I haven't seen before. Even during the rushes in the 70s and early 80s, there wasn't this kind of an inventory problem. And we've grown as a valley. We've doubled since the 60s. So right now, there are 200 plus listings on the market. That tells me that the minimum price increase over the next 5 months is going to be about 4 to 5%, period. No questions asked, doesn't matter. There's also another thing that Phil brought up in his slides that is true. There's a whole bunch of people that will be unfortunately passing on, and they're leaving a tremendous amount of wealth to their heirs. And I handle a lot of title insurance for families that maybe have 10 to 15 houses that dad and mom built up. Mom and dad passed away, and well, they live in Tennessee, they live in Florida, they live in Texas. And the first thing they say is, hey, let's keep 1 or 2, but let's sell the rest. So where does that money go? Well, it goes into their pockets, it goes into boats, cars, and other things, and it goes into some real estate somewhere maybe. But it's gonna, that wealth is temporary, but it's tremendous. So people can go out and buy their first home and buy $1 million house that we could never do because they've got that wealth from inheritance, not because they earned it working on the back lots, late hours. So we're going to see, again, housing prices continue to move up for all the things Fred said too. Lumber's more, labor's more. And if you're working in the city of Los Angeles, God bless you. The city building and safety offices are closed. You can go online and apply for a permit. But if you try to do that to build a building, oh, God bless you. It's never going to happen. And it takes 4 weeks to get a permit for a gas shutoff valve, an automatic gas shutoff valve to be approved. Wow, that's wonderful. So it's going to slow the process down. In the city of Los Angeles, unbeknownst to you guys, I was talking to a couple of the city council members, one who's not going to be, he didn't win his election, but Councilman Ruse spoken to me for about an hour and a half on Monday. And he said that there's a whole bunch of people in the building and safety and the inspectors area of the building and safety in Los Angeles taking early retirement buyouts right now, which means those people with 25 and 30 years experience will not be there to do property permit inspections. So there's going to be a longer period of time to get anything built or done, which means, again, a restriction on supply, which means if the demand stays the same, the prices go up. The interest rates have been spectacular too. And again, there are a lot of people taking advantage of it. And that also allowed somebody with $1 to buy more house with that same dollar. And Fred will be the first one to say, wow, that I can see it. And so will Phil. So again, if you're going to buy a house, there's never a time better than now, because now we know, will there be foreclosures? Absolutely not. zip. I know there's a lot of companies that have geared up for foreclosure business, but when you sell your house today, it's not like 2008. If your house just went up 6% last year and it's going to go up another 6% this year, that's 12%. You can sell the house and get back what you paid for it and make some money to move on. You're not going to be rich, but you didn't lose anything. So there are going to be people that are going to be able to absolutely sell their house and get out of it and move to another state, do whatever. So we won't see the foreclosures like we saw last time. And the banks this time around are really smart. They had maybe 20 or 30 servicing companies servicing all of their loans. Well, now there's a smaller group because a lot of those smaller servicers went out of business. So now there's about 12 servicing companies that service most of the loans. And they've talked to each other and said, hey, we're not going to just jump in and foreclose on houses. We're going to talk to each other. We're going to see what inventory is non-performing in what areas, and we're going to let the air out of the balloon really slowly. So you're never going to see it. You're not even going to know about it. And they're going to sell them on auctions.com, Hubzoo, all the rest of those sites that they put them out for the world to bid on. And so they're going to get top dollar that way. And so you're not going to buy something 15% under market. You'll have a better time walking the streets and looking for houses that are in bad shape and beating Phil to get the listing or buy it before it is listed. So there's my commentary about that. Again, the U.S. is the highest rate of return on their bonds and still continues to be without a doubt. So money's still going to flow into our bonds from all over the world for the security and for the return. Even if it's after the exchange rate's nothing, then they're going to still do it. By the way, the dollar has dropped against the Australian dollar about 18% in just the last 6 months. Our currency is falling against many of the currencies worldwide. So our goods will look pretty cheap coming out of this. And I believe that our industries, if they're backing on their feet, they'll be selling product worldwide if there aren't tariffs or other walls to keep it from happening. And back to cars. So again, I know Phil knows this. I talked to large car dealers, and I should really say like the heads of the sales divisions for Toyota, for Acura, and for Ford. And Ford, I don't get as many numbers from, but Toyota has had its largest, they were shut down for all of March. Nothing produced in the US. And they have 6 factories in the US producing cars. Nothing was made. They were gone for a month. And as of December, it looks like the sales for November equal what the sales for November were last year, which were great. And they're up about 4% this month over any month last year too. So there's a shortage of cars, and the dealers have done what housing's done. They don't have inventory sitting on the lot. If you think you're going to wait for one to buy it, when it comes onto the lot, they're pre-selling them before they're even delivered. So you're going to get what you get, or you pay the price to get what's there on the lot. And I don't see that very often because, cars, they're important, but they're like not the number one thing you have to have. But right now, the average sales price of a car is somewhere around $28,000, and it's going up, just like housing. So and those little Toyota Corollas are 22, and they're selling them like hotcakes. So again, my belief is jobs go away in some areas, absolutely. And if you're a poor restaurant owner, again, there's nothing I can say. I wish I could help you. The state of California has been really restrictive, and it's going to keep those people from being able to make a profit and to pay the lease and to pay their workers. So it's the lower end workers that are losing their jobs, and it's the middle lower end that's been hurt the worst here in the state of California. But I look forward to sunnier days, probably the second half of next year. And again, housing prices the whole time continue up. That's it.
Okay. So we're going to wrap it up. So there's various considerations to keep in mind for sellers and buyers. We can, as a seller, you can expect some more competition from other sellers and slower price growth than we've seen, particularly recently. But you can expect multiple showings or possibly offers. I would even say probably offers. Pricing needs to be realistic, and the house has to show well to get your best price. If you're going to relocate, you should have a game plan for relocating when you start your journey. You have to have expectations of how the offer is going to be written, particularly if you're moving from one house to another house. You have to sell your first house to buy the second house. And then you might find a buyer who's selling their house. So you have to understand how the offer needs to be put together. We help with that, of course. There's various showing protocols we have in place to shield people from coronavirus risk. So we can always talk about that in more detail. Buyers can expect historically low interest rates, and that's going to stay with us into next year. And of course, it boosts affordability. But we still have to contend with low inventory, meaning competing with other buyers. You need to be pre-authorized with a really good lender and have the proof of funds all ready to go when you write the offer.
You can't even show property anymore without a pre-approval letter to send the listing agent.
That's right. That's right. We're seeing it all over the multiple listing service. Send us your coronavirus advisory. There's a special advisory, your pre-authorization letter, and your proof of funds before you're allowed to show the property. That is a good point. Consider new construction. Now, new construction gives you a lot more options. However, it is costlier. Many of the new projects, or most of the new projects, have metal roofs. And then when you move in, you got to put in window coverings and usually a backyard. And quite often you want to upgrade the interior of the house. You don't want to use the builder-grade carpeting and so forth, particularly for a home that you're going to live in. And buyers should have flexibility for sellers' contingencies, meaning a seller needs to buy their home before they can sell the home that the buyer is buying. And work from home, here it is again. We're going to see homes being built with more rooms because people want to buy a home that's going to have one or two workspaces, maybe a classroom built into it, and maybe a recreation center or a gym or both. So we're going to be seeing that coming down the pike in terms of design considerations for new construction. With that, it's such an honor to be able to present all this information to you. We truly appreciate the relationships we have with each and every one of you. It means so much to us. We have a lot of resources we provide to you. We have a website, a Facebook page, a YouTube channel, Instagram. We'd appreciate a review of our services on Google in particular. We have a free smartphone app, which is geo-enabled. So if you're driving around, you want to see what a house is listed for, you just bring our app up. So you could text BHHS 1035209 to 8778. We have quarterly home buyer and seller guides, which just came out for this winter. And we've partnered with Fred with us on a very cool system called HomeBot. Fred and I have, and Joey have partnered on this, where we'll give you a monthly automated valuation on your home, as well as various financing alternative options and tools. A number of our clients are already on this, and they seem to like it quite a bit. If you want this particular slide or any of these slides or the whole deck, let us know. We'll be happy to furnish it to you.